Welcome. Today we're going to cover the care and feeding of your management accounting system based on the FBS E.CLIPSE management accounting platform. We're going to begin with some really basics about how E.CLIPSE works, and then we're going to go into some specific situations for those of you who are experienced E.CLIPSE users and give you some background on how to take advantage of some of the features of the program. So going back many years, E.CLIPSE is based on work that was done at the National Pork Producer Council in the late 90s, developing standardized production, financial, and managerial accounting standards. We've developed E.CLIPSE to meet the requirements of an NPPC, and then later the Farm Financial Standards Council has taken up that project, and we've made E.CLIPSE fit other commodities other than pork. We want to give a special thanks to the Latta Harris CPA firm that's given us a lot of advice in getting this set up over the years and has helped implement the system. And keep in mind that while we started at the pork level, we've shared the logic between the livestock and crops, and there's been a lot of things that are a lot of good parallels between those two different systems. So what we're really trying to do is adapt manufacturing inventories, manufacturing accounting for inventories to agriculture. And the common platforms, common denominators are that we use raw material inventories. Raw material inventories in agriculture are seed, chemical, fertilizer, feed, pharmaceuticals, and other products, which are transferred into work in process, which is the growing crops and animals. Now, work in process is particularly challenging in agriculture because we have multiple units. We need to be able to track acres and bushels and hundredweight, as well as just simple units. It oftentimes requires some estimations because we don't know until we harvest what our yields are or what our fertility is in breeding stock. And so we have to use some projected yields to get feedback during the growing season, use equivalent units to adjust on breeding stock for what's in the pipeline. And then we have finished goods inventories, which are the harvested crops or the harvested livestock that are basically on the truck on the way to market. We also want to be able to deal with traceability and drill down. And in agriculture, oftentimes we deal with production stages. And I'm going to show you an example in the next slide of some very complex production stages in the pork industry. We also need to be able to deal with movements between stages, making that easy to pull and push costs along, and then be able to deal with multiple levels of allocation. And we could do 5 hops with a payroll system, be able to track with employees to service enterprises, to consolidating enterprises, to crop production enterprises, to marketing enterprises, to the actual profit center for that commodity. So be able to look at these different allocations and be able to drill into the detail behind them. This is an inventory of a livestock feeding group, in this case pork, and we see the entire history of that group going through 3 stages: breeding stage, nursery stage, and this is the finishing stage. Not every livestock operation is this complex, but this illustrates what we're trying to accomplish. So we are tracking the cost by stage. Here's the animals went at $32.65 out of from the breeding stage into the nursery. Nursery added $17.93 per head, and then so far finishing has added $69.16. We want to be able to not only be able to track those stages and be able to adjust the cost as the animals are sold or moved out. We also need to track the individual account details. So we can look at of the current inventory, $64.37 of feed costs in those animals. We can look back at 1173 was on the breeding stage, 1210 was the nursery, and then 6162 includes the finishing stage plus these three other stages, two other stages. So we also track facilities and rent and other things that are involved in the process here. So we want to be able to do that and do it automatically, and be able to do some not just tracking costs, not just valuing inventories, but be able to maintain drill down and traceability values. To make things a little more complicated, there are 4 simultaneous views in the farm financial statements: cash, tax, the accrual, management, and market value. And so what we want to do is, as we look through the examples, is be able to drive most of our entries through cash, tax, running through expenses and revenues, and have the system develop the accrual, be able to internally make the management adjustments, and then we can always come through and add market value. That's not an automated function in Eclipse, but there are some easy ways to adjust inventories at market value. We want this to be user-friendly as possible, and so as I was saying, the most data entries are going to go through cash transactions, paying bills, buying feed, applying fertilizer, etc., and then production movements coming out of your own feed mill, death loss, animal movements, harvest, things that are not directly accounting entries, but not with, in this case, you're dealing with the raw numbers and having the system make the adjustments for you. So this allows us in our design a simple chart of accounts because we're multidimensional. We on accounts, we have centers, we have divisions, we have groups and projects and product lists. We want to be forgiving and allow iterative regrinds as you go through closing a month. There's always, you discover some posting errors. We make it easy to go back and make those corrections and to be able to adjust your allocations, and we'll look at that process later in this lecture. Having said all that, we do hit irreducible complexity. There is complexity. There's several things going on behind the scenes. We don't want to force the data entry people to understand everything that's going on behind the scenes, but there is a lot of complexity to make this happen. So back-end automation to do that is that, of course, we have import functionality for crop inputs, field applications, feed mills, packers, etc. So you don't have to touch the data. But the Eclipse system is doing automatic work in process accrual adjustments. We'll show you how that works. Yes. So you're entering the cash expenses. The system is going to adjust the balance sheet appropriately at the accrual level. We also do automatic activity-based costing. So system takes physical measurements and from your production records and uses that to drive costs. And then be able to allow movements at cost. Be able to just simply say, I'm moving this number of animals from group A to group B, and it retains the cost information as we record that. So with livestock inventories, we look at 2 categories. One is continuous flow, and this is there are no groups. Breeding inventories are good examples, and because there's no clean closeouts, it requires some estimates. What's the average time that the animals are in that particular pool, in that location? It also requires estimates as far as expected weaning averages and a few other things, so that we can derive equivalent unit calculations from the output of the breeding herd. Now we get to jobs, which include group, flocks, crop projects. We know we have a specific timing, starting period and an ending period. It's easy to do closeouts at that point. We know that everything is accounted for. And so we have, this translates to crop production projects, which we have a 1-to-1 for every field crop combination for the year. We'll have a crop production project, and within each project, we can do a complete P&L at that level. We have marketing projects, which there's will be 1 per center per year, typically per crop year. We'll market, for example, corn off of 50 fields. Each field will have a production project, but 1 marketing center, because we're not going to try to track sales out of each field. We're going to pool them to make it much easier to tie things out. Hogs and poultry, we define a project by combination of center and location. So in that building, on that farm, and then there's a date. Of course, there's a date associated with the beginning and ending of that project, that group or flock. And then cattle, so treat them slightly differently. We set the system up to track a user-defined 1 or 2 definition for that, independent of the location. So it allows us to move groups of lots of cattle between locations, whereas hogs and poultry are tied to a location. The group is tied to a location and a center. Well, here's what you get into as you're trying to adapt a management accounting system. You have to be able to tie out inventories monthly, or at least on a regular basis. Before you can run any kind of financials, you have to have your raw material work in process of finished goods inventories tied out. And that's the biggest hurdle. It has nothing to do directly with management accounting. It's just the reality of having be able to move costs through the system. So if we're starting a new client, we don't want to track more detail than you can accumulate or use to make timely decisions. So accumulate means that can you gather the information accurately and get it assigned and get it coded into the system. You don't want to take on more what you can handle. And then the question is, even if I do a lot of detail, can I make timely decisions with that detail? And so that's something that's unique to every client, every operation. Decide where you want to do, and you can always expand next season. Keep in mind that the management accounting is a moving target. But you need to start with what's important today, and then as you discover there's opportunities, you can keep doing continuous improvement as the years go by, seasons go by. So how does this work? And this schematic looks at 3 levels of entries. From the user standpoint, the user is making all the entries at the cash tax level. It includes production entries, which would be movements and harvests. But they are recording, here's transfer cost of animals, feed, and then direct costs. And this would be an equivalent of a group of animals, and we're building it up. But got time is represented here, month 1, 2, and 3. So just recording expenses, allocating it directly to a group of animals. But what happens at the end of every month, the system determines what the accumulated costs that occurred here, and it makes accrual entries that parallel the cash tax entries that go to the balance sheet. So it is keeping track of accrual values. And so while these expenses are expensed in the time period from a cash tax standpoint, they are rolled up into work in process inventories and maintained on the balance sheet. At the same time, there are also management entries that could be created based on activity-based costing parameters. So animal days, head in, head out, average inventory, things like that, tons of feed. They're getting charged off automatically as management entries. And so they start accumulating the indirect cost component of that group. At the same time, they're being allocated into work in process by accrual entries. So the accrual balance sheet includes both the cost of the animals initially for that stage, feed, the direct costs, and the indirect costs, support operations. When that group is sold or transferred out, and that could happen over quite a long time period, we peel off the cost, reverse the work in process, and we end up with same level of detail, account detail when we started. So these are created by we call shadow account entries, and we set up consolidating centers that do the allocations. We associate a shadow account with them, and these are the work in process WIP center entries. There is a WIP center, work in process center, for every production center in FBS. So it's all, these two are connected. These are automated. These are manual or imported directly. And we have a similar situation with crops. A little different time period, the same kind of idea. Here's direct costs. They're applied. They're being moved at accrual entries onto the balance sheet. We have allocations, activity-based costing, field trips, and other things that are being charged to that crop. And these are, again, shadow account entries and work in process entries. So that's the conclusion of our introduction to the management accounting, FBS management accounting, and we're going to move on now to opening balances. Welcome again. We're covering some specialized entries and processes with FBS E.CLIPSE management accounting. One of the first things is how do you get the opening balances into the system? One of the challenges in agriculture is that most operations, except the largest, have either a tax basis or market value inventories. So if it's tax basis inventory, there's no work in process on the balance sheet. So that's a blank slate. They have market value inventories. That's probably some arbitrary values, but it is something that you have to work from. So the ones that do have balance sheet with inventories on, that generally exists is either based on standard costing or it's incomplete, ignoring important details like adjusting for the current inventory value of gestating animals, or recognizing just the cash investment of seed, chemical, and fertilizer and growing crops, but leaving out the work in process contribution of labor, fuel, and machinery. So to get started, we want to pick the last day of the month. Now, 12/31 is ideal, but you can start any time in the growing season and the production system. What that means, though, is you have what we call short closeouts. So it's going to start all on a certain date. You won't have a complete detailed production records prior to that date. But it's very important in order to tie things between the financial statements and the inventories. So one of the questions that we run into is when we starting an inventory, do I make an accounting entry or a production entry? And either way is fine. If you already have an inventory on the balance sheet, then we can do a journal entry that takes reduces the inventory, the existing inventory that's generally at a really high level at the farm level, and splits it out to specific groups or locations. So we can make that happen. We can also, when we do that, we want to run that through the income statement, not the balance sheet. So we're pulling it off the balance sheet as a high level value, but we're running it into a purchase, into a group, or into a product inventory through the income statement, because remember, it's going to reverse it, put it back on the balance sheet. So we want to let the system do its job, and the goal is to be able to, if you already have balance on the balance sheet, to just allocate them from high level into groups or locations or projects. So you quote directly the input project or group through the income statement, either as a journal entry, accrual or management journal entry, or as a purchase within the production module, smart feeder or crop audit. Now, on a monthly basis, remember we have to tie out inventories monthly. This is what you have to have, and we have a detailed checklist we can go over through another presentation. But requirements in order to close a month, applications have to be recorded. That goes feed, seed, chemical fertilizer, anything that rolls into work in process. And we have to get the physical inventories balanced. That's essential. We don't need to know about the dollars because the FBS is going to do the dollars, but we do need to know the physical inventories match the real world. Next, we run the inventory valuation process and inventory valuation for crops or livestock. We want to make sure there's no variances in the current detail report, and the view history center totals should equal the transaction plus balance sheet amounts. Then we can do the GL tie out, which is going through the WIP inventory change report, and which should match the center totals in the view history report and the inventory input inventory reports, and then the WIP totals should match the accrual balance sheet. So I've got a schematic that describes this. So here are the reports you have available. Here's a livestock inventory report, a detail inventory report, and a crop inventory report for our work in process inventories. Here, all we're concerned about is make sure the quantities tie out. The dollars are going to happen in the accounting system. These are production reports. Same way though with raw materials, feed and crop inputs, we want to make sure that the inventories tie out, physical inventories tie out, and the dollars tie out, because these are all cost basis. They have to make sense. So if you return products, you make sure that you back them out the same value as what they were purchased in, because that will show up as variance within the system. So this information feeds in the inventory valuation summary by group or project, which is each one of these columns represents a project summarized by center, has totals by account, and we make sure that those numbers tie out, and they normally will, but I'll talk about some exceptions when they don't. And these feed into our WIP inventory change report, which is a master control report for inventories. Whereas this is tracking by project and group, this rolls up by center. This rolls up by project, shows the changes, shows the quantity, it shows the total dollars, the unit price, the changes due to that, and then each one of these lines will roll up into the balance sheet for crop inventories, livestock inventories, crop input inventories, feed inventories, etc. So there'd be a tie out, and part of the closing process is making sure that everything ties out, beginning with the raw quantities and then rolling up to the balance sheet. And one of the other things that practices need to follow is the standard cost vendor amount report. Now, the purpose of this is to make sure that all indirect costs are allocated using standard costing, and this is what the report looks like. Now, the easiest way to adjust this, and we have people who do a hard close every month, others that are just keep adjusting costs as they go through the year, depending on what your practice is. In this case, we're going to assume that you're adjusting costs throughout the year. So you run this, you set the period at the first quarter, and it'll duplicate for each quarter. It'll duplicate the allocations, and then exclude data after the end of the year. So what we're seeing here are what our costs that have been allocated, and then comparing against the standard and looking at the cost per unit, standard cost, the actual costs. So standard is what we started with. Especially in cropping, you're just estimating maybe based on last year, and then the system shows you what it actually is. Now, once I hit this button to view overhead, then I have opportunity to reset these values and get them adjust the standard cost to the actual cost. And this is a luxury you can have with cropping operations. You can adjust them at the end of the year, at the middle of the year, anytime. It doesn't hurt. And that's one of our goals of being flexibility, is iteratively you keep refining this, and at the end of the season, one practice is just to go ahead and reset all the standard cost to actual, so everything flows through. There's zero variances, and you go ahead. Others are doing this on a more formal basis, and they're closing the month and making changes, adjustments going forward. So what we have here is a virtuous cycle. As we start by allocating costs, we track units and adjust the cost drivers, and as we go through the year, we find based on our assumptions maybe didn't quite turn out as we expected, either volume variance or a pricing variance, and so this allows us to adjust it, and we end up with an example like this. This is looking at 3 years trend and standard cost vendor model report. We've color coded that to make it a little easier to see. The red is labor, the blue is fuel, the green is equipment, and then this one here is based on harvest acres, and it's determined that there were system has reset the value to 43.26 harvest acre for harvest, and so we can look back over the years what the dollars are and what the components have been. So different trading different machines and different levels of detail. But here's a look at some of the crop cost drivers that we can use as to update our indirect costs. All right, well, what can go wrong? And we're concluding this presentation with troubleshooting. And so as we see, different things can happen. Entries not within the group or project period. You're moving backwards or sideways. What does that mean? Changing inventories after WIP is calculated. Inventory values not zeroed out. And then what happens when you get new setup items? So let's look at these. All right. So group project errors are expressed by variances. And those of you, two types of CLIPSE users, people who are frustrated by variances and people don't know that there are even any variances there. So you run the inventory evaluation current detail report out of the input value inventories screen, you click the Find Problems button at the bottom, and then you can toggle back and forth between variances and period. So if there are variances, they'll appear in red, and breeding center variances will always occur because what we do is we set an estimated time period that they are that the gestation period would occur. There's no specific groups, and it pushes out cost based on an average, rolling average, whereas it's comparing against the month, may be high or low compared to that rolling average. So there'll be a 10-15% cost transferred out variance on that. So group centers, though, should normally be 0, and we're going to talk about how to correct that if they aren't. There's another situation, and that's, remember, we're toggling between Find Problems as the next period. Under the same report, you can find things, and here is an example of a feed ticket that was entered before the beginning date. And that really didn't have to happen because beginning dates on projects and groups can be any number of days before it actually, the first inventory occurs, first activity occurs. We're very forgiving on beginning date. We're not forgiving at all on ending date. Ending date has to be when the last sale occurred or the last animal moved out. It can be a little more forgiving on the crops. It'd be the last day of the month of the harvest. There's other things that happen. People record rebates or crop insurance or other things outside the group period. But to keep in mind that you got to be watching this. So this one here was, the simple solution was to go back and change the group period, recalculate. However, this particular client, they did hard closes every month. They just missed this. And this is actually, these gold, yellow warning would also appear in ticket ration report. So just a normal process of closing the month. They should have found this. This one here was, I think it was in March, and the group was closed in July. So here's an example of expenses entered outside the group period or project period. Again, these expenses will fall through the income statement in the time period. They'll never hit work in process. So you look over a long enough time period, it won't affect your bottom line, but in the short run, it will. It's understating cost of production. It's got costs going through that aren't hitting any group, and it's a simple matter of to enter in a logical time period. Now, this never happens with automatically allocated costs because they recognize the opening and closing time period. But manual entries of feed and applications and direct expenses, this will happen. Now here's some entries before and after the group period. In this case, death loss. Why they enter death loss before the group period, don't know, but that will screw up the divisor for a cost, and so you'll end up with a variance because it didn't recognize that these inventory changes occurred. Here's one, death loss after time period. Now these are blank death loss, so they won't have any effect, but you can see how they show up in color coded in the report. Okay, so moving backwards or sideways. Now that's a concept you have to understand the logic and how that's set up. So within each center, livestock production center, you can assign the stage of growth: breeding, nursery, finishing, and then we have different categories, subcategories: steers, heifers, mixed, transfer, and dairy, different dairy stages. Concentrating on the breeding, nursery, finishing, we have to always move in the direction of breeding, nursery to finishing, never to finishing and nursery to breeding. However, you ask yourself, well, what about wean to finish barns? How do I handle that? Well, use the nursery stage for nurseries and wean to finish. You can, if you're strictly always never using a nursery, you can, when you finish barn can be set up as a finisher. However, if you're doing double stocking or moving things around, it's always better to begin the first stage as a nursery stage. Even though it's not technically a nursery, we're expecting that. And we allow you to move animals once through this, from breeding to nursery to finishing. We don't allow you to move them. You can move them twice, but it does start creating issues. And the reason behind this is that when we calculate inventories, we have to start someplace, start upstream. And so we start with breeding and get all that calculated, and then the ones that are moved to nursery, and we calculate all the nurseries. Then we calculate all the finishing, and it's logical as it has to push those costs through. We have to figure out the upstream cost before we move to the next level. Here's a situation that many people aren't aware of, but within a stage, within a center, they're moving from a high number center to a low number center, and within the center. So once you get within the center or stage, it still has to figure out the order to process. So it's going to process the low numbers before it gets to the high numbers, as the lower numbers will be older groups. And so this case, this threw an error, or through a variance, not a serious one, but it was one that wouldn't go away because they were moving backwards from a high number group to a low number group. And this is sideways within a center, or in this case, two finishing stages at the same level. So that does happen, and the solution is moving in the right direction. Here's another situation. This is another look at one of these inventory valuation history screens, looking at breeding, nursery, remaining. And so here this tips off there's a negative inventory, negative physical inventory. Well, this happens when someone changes the production inventories after WIP is calculated. So it doesn't, WIP will adjust this if it finds a production entry, but something has happened for that group where they have sold or created death loss entry, changed the divisor, and it's going to be off. So the take home on that is that never let anybody make any physical changes to your inventory if you close the month, or even better, if you get ready to close the month, make sure that all the production entries, last second production entries, have been recorded. And so we'll keep the numerator and denominator in sync. Okay, here's something that will happen, and it has to do with rounding and occasionally just trying to correct things after the fact. And this is showing a little bit of here's just a little bit of dollars. Here's a penny, and this could be adjustment of some kind. It could be just a mistake that was made several months ago. We just need to correct it. This will show up probably most likely when you got a zero inventory, because it gets hidden. If you've got a 2 or 3 cent rounding error or something has happened, you normally wouldn't notice it. It wouldn't be relevant. It wouldn't be material as long as you got inventories in place. But you look at this, well, there's a -1. It kind of bugs you. It's showing up. So the way to fix this is you make an accrual journal entry to the WIP center, not to the production center. This is normally we're talking about getting things started. We're going to do to the production center, but here we're going right to the balance sheet account and inventory adjustment account, and we use one of these two vendors. You can put this on your vendor list and record that, and the system will, particularly using this to take dollars out. It works a lot better with dollars than it does for quantities. So just if you need to clean some things up, you got some old data, and it's carrying on some balances, you can use this practice. Now, you don't recommend recalculating after you put this in. This prevents this from changing, but you can reach some unpredictable errors if you or results if you go back in time and then recalculate past these entries. Okay, last item is new setup items, and what could go wrong? Well, we have what we call the WIP wizard that when you create a new production center, seed, chemical, crop, livestock production center, it creates a WIP, asks you if you want to create WIP centers. And so in this case, if it didn't happen, you get unpredictable results. Here we're in the inventory valuation setup, and this is the WIP tab. Conversely, we have facility centers and shadow accounts, and you can create shadow accounts automatically, but some kinds, like here facilities, we want to just use one shadow account for multiple facilities just to make sure this is put in place. So you need a process when something new happens, and crops, it maybe once a year. Livestock, it could happen more frequently depending on what kind of growth you're on, but make sure this is done before calculating inventories. And then you need to update the allocation table, and if there's something new and needs to be added. And again, the consolidating center exists, the shadow account exists. You can just go through the inventory valuation through the after running standard cost vendor model report that will recalculate what the values are, and it'll reset things. But if you added something new, a new operation or something else to track it, you need to make sure that the allocations are put in place. Thank you for joining me.